Namaste, and a very warm welcome to all our listeners tuning into FinWell Daily Brief. It's Thursday, March 27th, 2025, and we're bringing you the latest market scoop as it unfolded today, right up to the closing bell at 3:30 p.m. Indian Standard Time.
It's been an interesting day in the markets, wouldn't you say?
Oh, absolutely. We saw some pretty significant moves across various sectors and some global developments that are definitely worth unpacking. I think what we're going to do today is try to make sense of it all.
Decode those market whispers, so to speak.
Exactly. We're going to look at those numbers, the news, and try to connect the dots, drawing on what we've gathered from different platforms. Now, before we dive into the nitty-gritty of the day's happenings, let's pause for a moment and think about a fascinating statistic.
I do love a good statistic. Sets the stage, doesn't it?
It really does. A recent survey by the Reserve Bank of India in 2024, just last year, revealed that a striking 78% of Indian households prefer to park their financial assets in, well, bank deposit.
Bank deposits, safe and sound.
Yes, that classic preference for security. And it makes you think, doesn't it? As we delve into today's market performance, how does this risk-averse sentiment prevalent among such a large segment of households factor into the equation?
It's a crucial backdrop. Are we seeing a reflection of that caution in today's movements, or are there signs that a portion of the market is perhaps stepping out of that comfort zone?
Let's get into it then. Straight to the heart of the matter, the market report card, if you will. The Nifty 50, our benchmark index, closed today at 23,591.95.
A respectable figure.
Indeed. It climbed 105 NAR points, marking a gain of 0.45%.
Steady and upward.
Exactly. The Nifty midcap 150, it trailed slightly behind, ending the day at 19,175.40, up by 68.75 points, which translates to a 0.36% increase.
A more moderate climb.
Yes, but here's where it gets interesting. The Nifty smallcap 250, it really decided to make a statement today, closing at 15,111.65.
Now that's a surge.
A surge, indeed. A significant jump of 141.65 points, a whopping 0.95% gain. And rounding things off, the Nifty Total Market Index settled at 12,026.15, rising by 74.85 points, a 0.63% increase.
So across the board, we're seeing positive movement, but the small caps are clearly leading the charge.
They are. Now let's move on to some other key indicators. The 10-year government bond yield held steady at 6.70%.
A stable figure in the debt market.
And the Indian rupee to the US dollar exchange rate, well, it stood at 85.77 per USD. Minimal fluctuation there, possibly a ripple effect of those global trade tensions we've been hearing about.
Those global winds always have a way of influencing things here.
They do. Now, what immediately strikes me is this divergence in performance across the different market caps. The small caps, as we noted, really outperform the mid and large caps.
A tale of two markets almost.
Precisely. What do you think is driving this? Is it a case of while the big players are taking a cautious approach, perhaps a segment of investors are seeing more promising growth potential or maybe higher risk appetite when it comes to the smaller companies? It's a fascinating dynamic. Could it be that these investors are spotting opportunities where others are hesitant? Or maybe their investment horizon is different. They're looking for longer-term gains that might come with a bit more volatility.
It's definitely food for thought. Now, let's shift gears to some of the major financial and economic news that likely influenced the day's trading. First up, the rupee. It held its ground despite the usual pressure we see from importers demanding dollars, particularly as we approach the fiscal year-end.
The annual scramble to balance the books.
Exactly. It seems to indicate an underlying strength, wouldn't you say?
I'd agree. The fact that the rupee remains stable amidst these recurring pressures suggests that other forces might be at play, perhaps counterbalancing the demand. Maybe we're seeing stabilizing inflows or perhaps some strategic intervention by the Reserve Bank of India. It's a delicate equilibrium.
And then, of course, we had the U.S. president announcing new tariffs on automobile imports. Now, even though this isn't directly related to Indian policies, it definitely sent a wave of caution through global markets. A reminder that we live in an interconnected world.
Absolutely. A decision made on one side of the globe can still have repercussions elsewhere. Investors, naturally, become wary. Will this escalate? What implications could it have for global trade and supply chains?
Uncertainty is never a welcome guest in the financial world.
And finally, we observed a slight decline in the 10-year government bond yield, settling at 6.70%. A small dip, but in the world of finance, these subtle shifts can sometimes signal underlying trends.
They're like whispers that can tell a story if you listen carefully.
What story do you think this particular whisper is telling us?
Well, A marginal decrease in bond yields could suggest a few things. It might indicate that investors are finding other asset classes, perhaps equities, given their strong performance today, more attractive at this moment.
So a slight shift in preference.
Possibly. Or it could signal an anticipation of future interest rate adjustments. Bond yields in equity markets often have an interesting inverse relationship.
So one goes down, the other tends to go up.
Precisely. These small movements in the bond market can be quite telling.
All right, let's zoom in a bit further now. Market outlook and analysis time. The Nifty 50, with its 0.45% rise, tells a story of resilience, especially among the blue chip companies.
Those well-established giants of the market.
Do you think this reflects some positive undercurrents in the domestic economy, perhaps factors that haven't necessarily made it to the headlines today?
It's certainly possible. The performance of the Nifty 50 often mirrors the overall sentiment towards the Indian economy's fundamental strength. It could be driven by positive earnings expectations for these large-cap companies, or maybe a sense that the broader economic environment is conducive to their continued growth.
It's a reassuring sign for those investors who prefer a less risky approach.
Exactly. Stability and steady growth, that can be quite appealing.
Now let's talk about the mid and small cap performance. The small cap 250, as we mentioned earlier, really outshone the mid cap 150.
A remarkable difference in performance.
Yeah. It seems to indicate a different strategy at play. What are your thoughts on this appetite for smaller companies?
It could be a reflection of investors seeking higher growth potential, even if it comes with greater risk. These investors might be identifying niche sectors or emerging businesses with the potential to deliver significant returns, even if it takes a bit longer.
So a more aggressive, growth-oriented approach.
Exactly. They're looking for those hidden gems, those companies that might be poised for a breakout.
Shifting our attention to the currency and bond markets now. The rupee holding firm at 85.77 per USD despite those fiscal year-end adjustments.
It withstood the pressure.
It did. It really paints a picture of equilibrium, doesn't it? Like a delicate balancing act.
A tug of war with neither side gaining a significant advantage. The demand for dollars to settle year-end accounts is a recurring phenomenon, so the rupee's stability suggests that other factors were strong enough to counteract that pressure. Perhaps it's a combination of dollar inflows and a proactive approach by the Reserve Bank of India.
Now, that slight dip in the 10-year government bond yield to 6.70%, what are your thoughts on that?
Well, it could be a sign that investors are reassessing their priorities, weighing their options in light of the current market dynamics. Maybe the potential for higher returns in the equity markets is currently outweighing the appeal of fixed income securities.
A shift in perception, perhaps.
That's precisely. Investors are constantly evaluating the risk-reward landscape, seeking the best avenues to achieve their financial goals.
All right, let's get sector-specific now. The automobile industry, it's facing this new wave of uncertainty with those U.S. tariffs. Even if the direct impact on Indian manufacturers isn't immediately apparent, it introduces a new element of risk into the global automotive landscape.
The ripple effects can be far-reaching.
Investors in this space must be feeling a bit apprehensive, wouldn't you say?
Understandably so. The automotive industry is a global network, intricately connected through supply chains and trade agreements. Tariffs imposed by one major player can disrupt those connections, creating a domino effect. Indian auto companies, particularly those with significant export exposure, will be scrutinizing their operations, assessing their vulnerability, and exploring strategies to mitigate any potential negative impact.
Now, the technology sector, it's always an exciting one to watch. Here in India, it's brimming with potential, but it's also grappling with the ever-evolving global challenges.
A sector marked by innovation, dynamism, and a constant need to adapt.
For investors venturing into this space, it feels like a continuous exercise in analyzing innovation, evaluating export prospects, and navigating the regulatory landscape both domestically and internationally.
Absolutely. The tech landscape is constantly shifting, shaped by technological breakthroughs, global economic trends, and evolving regulatory frameworks. Investors need to stay informed, agile, and adaptable to make informed decisions in this dynamic environment.
And finally, let's talk about the banking and financial services sector. It's often viewed as a barometer of the overall economy's health.
A crucial pillar of the financial system.
With the fiscal year drawing to a close, the scrutiny on credit growth, asset quality, and the direction of interest rates must be intense.
These are the vital signs that reveal the sector's well-being.
Investors will be closely watching these indicators, trying to gauge the sector's resilience and its potential to drive economic growth.
And by extension, the potential for returns on their investments.
So, to wrap up our discussion today, What are the key investment themes that our listeners should be keeping a close eye on, particularly in light of today's market movements and the news we've covered?
I'd say there are three key areas to focus on. First, the evolving landscape of global trade policies, especially those tariff announcements. Investors with exposure to sectors that rely heavily on exports need to understand the potential implications and stay informed about any further developments on the geopolitical front.
Global events can have a significant impact on local markets.
Absolutely. Second, the monetary policy stance of the Reserve Bank of India remains a crucial factor. Their decisions regarding interest rates and liquidity management will have a ripple effect on both equity and debt markets.
Anticipating those moves can be quite strategic.
Indeed. And finally, the realm of emerging technologies continues to present exciting growth opportunities. Sectors like renewable energy, fintech, and digital infrastructure are showcasing remarkable momentum. Identifying and investing in companies at the forefront of these advancements could yield substantial long-term value.
So, summing up our analysis today, we saw a market that was cautiously optimistic, influenced by a blend of domestic economic indicators and those ever-present global trends.
It's a constant interplay of factors.
As we approach the end of the fiscal year, it's a reminder that a strategic, informed approach to investing is more important than ever.
Absolutely. Understanding these dynamics, assessing risks and opportunities, and making well-informed decisions are essential for navigating the complexities of the market.
All right, before we conclude, a few quick reminders for our listeners. To stay ahead of the market curve and get your daily dose of insights, be sure to subscribe to Finwell Daily Brief.
Your go-to source for all things finance.
And we encourage you to connect with us and the vibrant Finwell community on LinkedIn. Just search for SOS Finwell and you'll find us there.
We'd love to connect with you.
And if you're looking for more in-depth discussions or personalized financial guidance, don't hesitate to reach out to SOS Finwell on LinkedIn as well. We're always happy to engage with our listeners.
Feel free to reach out.
And on that note, let's leave you with a thought-provoking quote from the wise Benjamin Franklin.
A timeless piece of wisdom.
He said, "An investment in knowledge pays the best interest."
Until next time, may your investments be wise and your knowledge ever growing.